With us live on the Dow Jones Investor Network is Tom Rizk, President and CEO of Cali Realty. Thank you for being with us this afternoon.
Thank you, Barbara.
If you can start us off with explaining what is Cali Realty's focus, what kind of property types, what kind of geographic areas?
Cali Realty is an office REIT based in New Jersey. Our focus is northern and central New Jersey. We have acquired office buildings and what we call office flex properties, which are a combination of office and some storage space. We own about 4 million square feet of space in New Jersey. That's predominantly in northern New Jersey with some in central New Jersey. One property is located in New York State.
That one property in New York State seems to stand out. What are you going to do with that? Are you going to go into New York eventually or get rid of that one or what?
We have no intention of getting rid of that acquisition. In fact, we think that was one of our better acquisitions. Our intentions are to really focus on the region. Truthfully, that property is very close to the northern New Jersey border. We consider that part of the Bergen County market. But really, our focus today is not strictly in northern and central New Jersey, but we're looking at the region. We have a lot of acquisitions to do right here at home, however. The northern and central New Jersey marketplace is the fourth largest office market in the country. It's about 140 million square feet of space, and there are about 1,700 buildings in that market. So there's plenty of opportunity for acquisition right here at home, and that's certainly where our thrust will be. But we always look at the region and what's going on in the markets around us, the borders of New Jersey. And when the opportunity arises, we wouldn't hesitate to do that if the right acquisition opportunity presented itself.
You say right here at home, you meaning New Jersey, right?
Yes, I'm sorry.
Not New York and New Jersey.
No, I mean northern and central New Jersey.
When you say you're going to focus on this region, how far out is this circle that you're going to focus on?
Well, I think certainly our game plan was to begin right where our headquarters was in Cranford. That was really the evolution, and to build out from there. So we've gradually been expanding our market penetration. Our game plan really is to focus on particular submarkets where we think we can obtain a competitive advantage, either because we have the best property or acquiring the best property in that region, or because we have the most amount of properties in that particular submarket so that the tenants have fewer choices, or because we have a service reputation in that market where the tenants want to be in our buildings.
Is the strategy going to be acquiring properties as opposed to developing properties?
Well, in our market, particularly the office market in New Jersey, right now the economics do not make sense for speculative office development. We think you'd have to see about a 20% increase in economic rents to justify speculative construction, and we think that's a number of years away. The exception to that is an occasional built-to-suit opportunity where you have a pre-leased building, an entire building, or the majority of the building. In the flex property type, particularly in an acquisition that we closed in November, the Commerce Center, there may be an opportunity for expansions in that particular project where we might do a 40,000 square foot expansion to accommodate the existing tenants and the extensive demand there. But as a general rule, development in the near future is probably not where the thrust of our company will be.
What are your acquisition plans for, especially in 1996 and in the next few years?
Well, certainly we will continue.
You've got 4 million square feet now. How many will you have at the end of 96?
Okay, fair enough. Let me just step back a minute. We had 2.2 million square feet of office space at the time we did our public offering in August of '94. And in 1995, we acquired about 157 million of properties. We added about 27 properties. And so we had a fairly ambitious acquisition track record in 1995, increased the size of the portfolio by about 70%. This year, we see the complexion of the pipeline a little bit different than last year. We see more portfolio-type potential acquisitions. So there's been a little bit of a shift in the complexion of the pipeline, but still a very strong pipeline in terms of the number of acquisitions and the amount of volume. We really haven't published to anyone what the exact number we think will be or what our target is. I think the street, the analyst consensus, has been somewhere between $75 and $100 million of acquisitions for 1996. And generally the pace picks up in the latter part of the year. That's so far has been our experience.
Your lease rate in the fourth quarter was 92.5%. What's your goal in terms of leasing, and where do you see that number going?
We think we have a little bit of room to pick up the occupancy rate in our portfolio. We've seen steady, gradual improvement in the market for a long period of time. Actually, from the first quarter of 1992, really through today, we have seen not dramatic, but constant and gradual tightening of the office market, and we think that trend has not stopped. I know there's been some discussion about the economy slowing down a little bit. We haven't yet seen it on the leasing side, so we do think we have some room to push the occupancy rates up.
I think the New York Times recently wrote a story about unemployment in New Jersey, and the numbers looked very bleak, and it looked like it was going to get worse. What concerns do you have about that, and do you expect that to have an impact?
Well, we've seen, it's interesting, that report came out based on the December statistics, and then I think recently the January statistics showed a blip back down from December. I think you've seen some modest adjustment recently to the overall picture. And the overall picture, I think, has been, again, some steady improvement. I know there are economists now who are saying, well, we could see a recessionary period, perhaps a minor recessionary period. We don't see that. So far, anyway, what we have seen is, even with all of the economic news that's been published so far, we continue to see a modest upward pressure on the demand for space. So far that has not trickled down to us. If, however, there were countrywide a mild recession, we think the office and the industrial sector on the REIT side would be the sector that benefited from that. The reasons being there are longer term leases as opposed, for example, the apartment market where you have much shorter leases, and we have seen some significant hits to the values of the retail companies, and I think there's still some that'll have to play out a little bit before we see any change in that. So we do think even if there were a mild downturn in the economy, investors may be looking at the office and industrial sector as a haven.
What kind of growth rate do you promise potential investors over the next few years?
I never promise an investor a growth rate.
What do you talk about in terms of growing the company?
Well, I think the market, I think, looks for something like a 15 to 20% total return to the equity investors. I think if you look at our track record in 1995, our investors received about a 50% total return on their investment, with about 37% of that coming from stock price appreciation and the balance coming from dividends. And I think as far as our track record is concerned, that probably makes us one of the best performing REITs in the country in 1995. On a going forward basis, I think what we've heard the investment community look for again is they're looking for something between a 15 and a 20% total return on their investment.
What would you say to analysts who want to distinguish Cali from other office REITs? How would you distinguish Cali?
The way I would distinguish Cali is really twofold. I think the management team, we really have a focus on teamwork in our company. We have added some key personnel to our company. We really have a very tightly knit group of aggressive managers who are really seeking to make a name for themselves and align their interests with the interests of our shareholders. I think the other thing to look at is our focus. We have been very, very focused on the fundamentals on the real estate side. We try not to let the little blips in the market change our plan of action. And I think we've laid out a plan and we've executed it very well since our public offering. And I think investors are attracted to that.
Okay. I read somewhere that FMR now owns 13% of the shares outstanding. Is that a vote of confidence? How do you view that ownership?
Oh, I definitely view that as a vote of confidence. I think Fidelity has really focused on companies with strong management teams and a good focus. And we have, if you look at the rest of our institutional base, you'll find a lot of the who's who investors in our stock, and we think that's a credit again to the management team.
How involved is Fidelity?
Involved? They're not involved. They really exercise no influence over management. They're really an investor, but we're certainly glad to have them as an investor.
Okay. You also have a $75 million credit facility.
Yes.
What is that money earmarked for?
Well, we have two credit facilities. We've got a $70 million credit facility, as you point out, and recently we entered into a second $75 million credit facility. And generally speaking, that credit facility is used for acquisitions. There really has not been a need for any capital expenditures other than acquisitions to come out of our credit facility. The rest is taken care of out of cash flow.
Okay. One analyst wrote in December that viewing the portfolio as a whole, approximately 20 to 25% of Cali's leases expire over the course of the next 2 years and therefore present renewal or releasing risk. How do you address that risk for investors?
We think if you look at our track record over the course of a long period of time, if you examine our leasing statistics really beginning from 1990 when our market really took a hit in terms of an economic downturn, we achieved very high tenant retention, something in the neighborhood of 65 or 70%. And that was in a marketplace that had far more vacancy than our marketplace has today. Today our market is much healthier. We think 15 to 20% in a market that's showing gradual tightening is really an okay thing over the next 2 years, as you point out.
What is the worst case scenario? What is it that you worry about? Let's say New Jersey goes into a recession that is stronger than the U.S. economy and downsizing continues and it hits New Jersey. What do you worry about?
What do we worry about? Well, first let me address your scenario. I think if New Jersey were to get hit harder, and we really don't believe that, but if that were to happen, we're really an acquisition story. So we have the opportunity for a win-win. If the market continues to improve, we'll begin to show significant rent growth internally, and that'll be a good thing. If the market takes a step backwards, I think that'll present opportunities for us to do acquisitions. And I think to the extent that there are opportunities because a particular tenant moved out or vacated a building, we have the opportunity to acquire property at a lower cost than we could today and turn that into a positive.
Okay. Let me ask you if you're comfortable with the analysts' earnings forecasts out there. For the first quarter, 55 cents a share, I picked up on First Call as a consensus. Are you comfortable with that number?
Well, let me try to address that this way. If you, again, look at where we started. I think the first numbers out of the box in our prospectus were about $1.83 was our run rate that was predicted. I think our last quarter was 52 cents a share. So we've had about a 16% increase in our FFO per share over 1994. So I think so far we've done a good job, and we've been right on target with where First Call is. And that's about all I'll say on that one.
Okay, that's good enough. Tom Rizk, President and CEO of Cali Realty, thank you for being with us today.
Thank you very much, Barbara.
This is Barbara Martinez for the Dow Jones Investor Network, live in New York.